What stocks and ETFs offer the most profit potential in the new year? Well, here at Money Show, we've asked our top experts that very question every year for decades. And the result is our annual Top Picks report. The 2025 edition clocks in at 90 pages. It features 78 picks from 44 different experts. And these analysts, traders, editors, and other contributors are specialists in a wide range of markets, sectors, and asset classes. Today, 3 of them have joined me for a very special Money Show MoneyMasters Podcast roundtable. They'll tell you how they arrived at their picks, why they chose the names they did, and what unique features make them so potentially profitable. Joining me are Tom Hayes, founder, chairman, and managing member at Great Hill Capital, as well as the editor of Hedge Fund Tips, Mish Schneider, chief strategist at MarketGauge.com, and Chris Preston, investment analyst and editor at Cabot Wealth Network. Thank you all for taking some time out to talk today.
Thanks for having us.
Thanks for having us.
Yes. Yeah, great. Again, a lot to talk about there. I want to kind of avoid getting too macro or big picture views with this episode, but I do think it's important to ask something right off the bat, and that's, is this finally going to be the stock pickers market we keep talking about? We've had this just buy big tech and you're fine otherwise. Tom, why don't you start with that and let me know if that is the case, why or why not?
Yeah, I think that's a great question. That's the $1 million question for this year, Mike. Thanks for having me. I think what we're seeing, though, if we're realistic and objective about what's going on in the market, what we are seeing is a deceleration in earnings growth for the Magnificent Seven, which kind of has driven the bus looking backwards. Earnings growth dropping from 33% last year to 21% this year. However, the multiple on the Magnificent Seven has not yet derated in accordance with the earnings growth deceleration. So I think they're going to perform less well. They'll do okay this year. But if you contrast that to kind of the broadening theme and take a look at the other end of the spectrum, going from large cap growth to maybe small cap value, you look at earnings growth acceleration in the small cap 600. Earnings growth is growing from 8% last year to 21% this year. The difference is for that same 21% earnings growth, whether you talk about Mag 7 or you talk about small caps, is the price you pay. And on Mag 7, you're still paying 33 times earnings for 21% earnings growth. On small cap, you're paying 15 or 16 times earnings for the same 21% earnings growth. So I think that this is, in fact, going to be the year of the stock picker. You can look under the surface. The idea of setting on autopilot and letting the indices take you to paradise is probably going to be a little less well-founded in 2025 than it was in 2024.
Got it. Mish, it looks kind of like paradise in the backdrop there. You're in New Mexico, I know. What are your thoughts there? Is this finally going to be that stock pickers market?
Well, first of all, yes, thanks for having me on as well. And yes, that is Santa Fe, New Mexico behind me. It is paradise. But unfortunately, paradise is very ephemeral, as we know, and especially in the market. So I agree a lot with what Tom says in terms of a stock picker's market. I could argue that it's always, in essence, a stock picker's market, except when you have a consensus of almost 100% that it's all going to be heavy in one area, like we've seen over the last 2 years in tech. It just makes everybody look that much smarter. So I think this year we will really see somewhat of a separation between, here's a woman saying this, the men and the boys, if you will. So that's kind of how we're approaching the market. We have a factor that we have not had since right at the end of COVID, which of course is Trump. And that we saw today was a perfect example of how headline sensitive this market is going to be. And he loves to create headlines. Today alone, there were about a half a dozen, ranging from a hostile takeover to Greenland to interest rates are too high. So the market is going to need to settle in. And so in terms of a stock picker's market, I think the best tip I can say is that in January, after 10 trading days, we have what we call a 6-month calendar range. That range is going to be uber important for in terms of deciding which stocks will break out of that range and will be sort of Trump friendly, if you will, which will sort of chop around and which will break down. And that will make it easier for us stock pickers.
Got it. Chris, I'm going to pivot to methodology in a second, but I just want to see, is there anything else briefly you'd want to add to that sort of the big picture view there?
Yeah, I feel like both of what Mish and Tom said is pretty spot on. It could both be more of a stock picker's market, but also a more democratic market. There's been the least democratic bull market the last, what is 25, 26 months now, where it's carried by, a few dozen stocks, I mean, Mag 7 in particular. But, a lot of stocks have not participated. Small caps have not participated. They're up like, 3% last year and are still below their 2021 highs. You look at the equal weight index, it's lagged S&P, NASDAQ by a long shot. I mean, the Dow has trailed by a similar margin. So I think there's a lot of, I think, yes, stock pickers market, but there's a lot of good stocks to pick from because there is value out there. So I think, I saw a stat the other day from Ryan Dietrich of was it Carson Research Group, who said, there's been 8 times since 1950 that the S&P has been up 20% back-to-back years, and all 8 times it's been up another 20% the next year. I don't know if I would forecast that, 9 for 9, but the idea that the bull market will, bull markets don't die of old age, and this isn't even old age. The average bull market lasts, over 60 months. So we're not even halfway there. Doesn't mean, there are factors that could derail it, but I think it's a stock picker's market, but also a environment ripe for picking a lot of good stocks out there.
Well, Chris, you brought up a good point there at the end, and that's methodology. I mean, how do you approach your market analysis? What is it that you focus on? What is it that goes into picking a top pick, whether it's for this Money Show project or anything for that matter?
Yeah, so I run at Cabot Wealth Network. I run 2 very different advisories, newsletters. One is a value newsletter, and one is more growth heavy. And even with the value one, I tend to be more growth oriented. Even with the value one, I try and look for growth at value prices. And I think, value has underperformed growth for more than a decade now. Doesn't mean it's, historically that's not the case, but so it doesn't mean that's going to last forever. But, I guess I'm maybe more malleable than, I don't stick to one system and just ride that, for the next few decades. Yeah. So, I like looking for value now, but it has to have some sort of growth aspect. Even Warren Buffett has, Apple, BYD, several growth stocks in his portfolio that he's found value in. But yeah, I think there is such a limits to, growth. I think Tom just outlined the slowing down of the Mag 7. And that's why I look a little bit more for value, because there's less value there. I don't think they're going to suddenly, reverse course and fall 20% this year. But, a blend of value and growth is sort of my philosophy, I guess.
Tom, I know from previous conversations, you kind of had that nickname, Turnaround Tom. So I know that value is where you like to be looking. Talk about your methodology. I mean, how do you separate a value opportunity from a value trap?
Yeah, I think that's a great thing to point out. And I agree with some of what Chris said. We do like to see growth, but price is what you pay, value is what you get. So we do look for stocks that are down a lot in terms of price. And then we try to distinguish whether value has been destructed on an equivalent basis. And what we find across most of the durable businesses that we get involved in, number one, they've been around for many, many years. They've operated through many cycles. They're going through a temporary impairment like they have through different cycles, whether they're a cyclical business or they've had different other headwinds in the past. And the first thing that we do is we look for solvency risk. So if a stock's down 50 or 60 or 70 or 80%, the market is saying that there might be an existential crisis. So the first thing that we say is, are they going to make it through this cycle? Are they going to live another day? So that comes down to balance sheet analysis, looking at the debt, looking at when the maturities come due. And if I can get comfortable with that, then the key is going to be leadership. Do they have a new jockey that has a track record of success? That's a key factor. And then finally is free cash flow. Do they have enough runway to execute on the turnaround plan? Because obviously it's been mismanaged to some degree, or the stock wouldn't be down 80%. But these are durable businesses, whether we're talking about, Disney that was at one point down 60%. Disney's not going anywhere. Boeing, 70%. These are high quality, durable businesses that fell on rough times, but they're not going anywhere anytime soon. So now, to distinguish between a value trap, I think people get caught in that just because the price is down means it's cheap. And that's not always necessarily the case. Oftentimes, a stock that's down a lot deserves to be down a lot and may face an existential crisis. So that's something that you need to be able to discern from experience and doing proper analysis and not just looking at price. And two is doing lazy asset analysis where you say, well, the breakup parts alone is worth more than the price that it's trading at, but there's no catalyst for a recovery of growth. There's no turnaround story. There's no new leadership. And I think that's where people get stuck in quote unquote value traps. And by the way, many of the greatest value traps are broken growth stocks, okay, that never ever recover. People forget that. As it relates to value generally, what I see in the market right now is people blinded by recency bias, in that because since 2010, growth has outperformed value, therefore it's always going to persist, meaning what's happened in the recent past is going to persist. And if you look back to 1927, value has outperformed growth by 4.5% per year, including this aberrational zero interest rate policy environment. And my kind of view there is value and growth are tied at the hip, number one. So it's not either or. I don't buy something because it's a value stock or because it's a growth stock. I buy because I'm getting a lot of value for less price than the alternative's highest and best use of the capital. And I think that unless you believe that we're going back to zero interest rate policy or close to it, not having some element of value and or international, which is also trading at low multiples and small caps, et cetera, is maybe a little risky at the moment if you've got all your eggs in one basket. Because I think we are in a period of regime change, and that's going to create a lot of opportunities, a lot more opportunity in 493 stocks than in 7.
Got it. Mish, I want to make sure we leave plenty of time for everybody's picks, yours included. So I'm going to kind of pivot to that part of the conversation with you and give you the microphone first. I find it interesting, your pick in the healthcare, kind of this GLP space. It's interesting. The top performer among the 2024 stocks was actually a company called Viking Therapeutics from John McCammon, a biotech firm that's got a potentially promising anti-obesity drug that's in development. So why don't you talk about your pick there?
Yeah, and I just feel because my esteemed co-panelists here are not technical traders, that I think it's really important to know that market gauge is a little bit different because we have quantitative models that really basically blend across all asset classes, from sector rotation to NASCAR. Excuse me, I've got NASCAR in the brain because I'm going to talk about one of my picks. But to NASDAQ leaders, to everything, pretty much. So we do that based on trend strength indicator, and we also do that on earnings growth, especially when we're talking about small and mid cap stocks. So I just wanted to say that because my own personal picks are really a hybrid of fundamental and a lot of the value that Tom just talked about, looking at growth stories. But also, really, I have to use charts. I must use charts. I spent 14 years on the commodities exchange as a chartist. And even though there were some fantastic bull moves during that time, I was able to anticipate based on breakouts before other people. And that's kind of my wheelhouse. So my two picks are related to that. So to talk about the first one, you're mentioning AbbVie, ABBV, which was a pretty good performer in 2024, but not necessarily as good as it had been before that. I like it for a couple of reasons. Number one is in the biotech space, which to Tom's point might be something that can really move up this year. Not only is it involved with a lot of neuroscience and immunology, which of course we saw a big move today in Moderna off the lows, but also they have Allergan is that one of their sectors that they have in their company that does Botox.
Yeah.
Botox, in terms of the vanity trade, and this is really part of my theory, is that with the diet drugs, the people are going to spend more money on themselves. So we go from a we to a me, if you will, or what I'm calling vanity. And AbbVie can benefit from that because, as we know from a practical standpoint, from an aesthetic standpoint, when you lose a lot of weight, your skin tends to sag and wrinkle. And Botox is a really big fix for that. So that's where my story comes from. They also pay a dividend, and they've been paying a dividend for many, many years. So they're a good, solid company. In terms of the actual chart points right now, it seems to have, and this is where I would talk, 160 to me is my baseline support. Breaks down under 160, I would not necessarily want to be a buyer. But right now it's been trading somewhere between 175 and 180. And so we get through these recent highs, these January highs to my first point, then I think this has a potential to be at least a $300 stock this year.
Good, thanks, Mish. Chris, I want to pivot to you. I mean, you've got to pick. I'm a Starbucks guy, so it's interesting to think about this other one. It's Dutch Bros, correct? It's not short for brothers.
Exactly. Yeah, I actually. So I live in Vermont, and we don't have a Dutch Bros here. So I was shamed when I said Dutch Brothers once on our Cabot Street Check podcast. Our producer shamed me for saying that. But yeah, Dutch Bros. Right. That's yeah. Well, it's not in Starbucks' stratosphere yet, but it's a drive-through coffee company that has now 950 locations in, I believe, 18 states and Washington, D.C., with a very aggressive goal of expanding to over 4,000 locations within the next 10 to 15 years. It's been adding over 30 locations each of the last few quarters. I think it's on track for over 150 new locations in 2024. And the growth, as for the stock, it was up over 85% in the last year, but it's still trailing its 2021 highs. It's currently trading at 57, roughly 57 a share. It was 76 in late 2021. And given the growth and the expansion, will it ever be a true threat to Starbucks? No, or probably not. But given the sort of Starbucks sort of swallowed up the coffee market, swallowed the U.S. coffee market whole, and it could. I think there's room for a little bit of competition, and Bros, at least in its its ambitious expansion plans, is trying to sort of fill that void. And, so far so good in the last year. And I think the momentum will keep up for the next year.
Great. Tom, I got to ask you about your first pick. I mean, it's one of those names that just can't stay out of the news, and not in a good way. So sell me on Boeing here.
Yeah, well, Boeing is what we call a legal duopoly between Airbus and Boeing. They deliver 99% of the commercial aircraft. As far as the recent crashes, which have been terrible, they're predominantly concentrated to the older planes. The fear was that it was around the 737 MAX, which has had a ton of problems. But they got rid of the old CEO. Fortunately, we've got Kelly Ortberg in, who has an engineering background versus a sales background or a financial engineering background, and that's a good thing. He's on the floor in Seattle. He's fixing all of the problems. He solved the labor union strike. And when he was at Rockwell Collins before he came here, he created a lot of value for shareholders. Rockwell Collins quadrupled in value for shareholders before it was sold in a period of 6 years. He's a turnaround specialist. They have a $500 billion backlog. I mean, imagine buying a business that had 10 years of demand that they couldn't possibly fulfill, that they didn't have the capacity to fulfill all at once. It's a great problem. You got airlines waiting, and sure, they can get angry and say, the landing gear didn't come down right, or the door had a problem, et cetera. And they're working on fixing all of that. But at the end of the day, they can say, fine, I'm taking all my business to Airbus. And rather than wait 10 years, they're going to wait 20 years for their planes. So that's not an option. What they have to do is work with Boeing. And that's what you've seen, whether it's Southwest, whether it's everything else. And the commonality across all the carriers is they have utmost confidence in Kelly Ortberg's engineering prowess, safety excellence, and turning the company around. So with the stock down, that's down that materially, some 70 something percent. It fell maybe peak to trough. and you have a business that's going to get back to free cash flow positive. They raised $20 billion of cash to take solvency risk off the table. All the components that I look for, turnaround Tom looks for in a turnaround situation, are perfectly in place. Pricing power, durable, sustainable moat, performs through cycles, pricing power. It's all there. You just have to be patient. Now you play the time arbitrage game, and most people can't wait 2 to 3 years for a double. But we're patient. We like to do that, rinse, repeat over and over. And we think Boeing is going to be one of our next ones.
Fair enough. Mish, I know you and Chris both had automotive plays kind of in this EV space. So why don't I start with you first, Mish? Rivian was the name you were looking at.
Oh, now you've got me curious about what Chris picked. Okay, well, yeah, Rivian. Well, I'm very much like Chris. This is somewhat of a controversial call out because I've been seeing a lot of reports about the EV hoax is over. And certainly with drill, baby, drill, people think the gas prices will go so low, people will go back to gas guzzlers. But I don't believe that at all because, first of all, even Elon Musk has basically said that 99% of the people who drive EVs do not go back to a gas car thereafter, number one. And number two is that the future obviously is an EV. And when you're talking about software technology, particularly self-driving cars, as far as I know, that will be a lot easier to execute with EVs. So why do I like Rivian? Well, Rivian has, again, this is a fundamental technical story, right? Consumer instinct. I've seen a lot more on the road, particularly when I went back east and went to Massachusetts. Interestingly enough, I saw about 5 Rivians in a very small town. So that I was already in the stock, but still I thought that was interesting. They made a great deal with Volkswagen in 2024. They've gotten a lot of government money to build their plant in 2024. And their recent problems, which were how many cars were they going to sell and a shortage of supplies that they had in terms of their parts, both got resolved recently. And so the number of cars beat. And apparently now they do not have the supply chain issues with their parts. And so that's why we saw the stock just this week go from like 13 up to 1660. And now with the market coming down, it's settling down. That one big day was such a huge range. It's now basically consolidating within that range. So, all of these are reasons. And the final one is, again, in the Trump administration. I do believe that anything made in America will actually, and by the way, Boeing made in America, will actually be a plus for companies because they may get incentives. And there's been talk about EV incentives going away. I don't think that will happen. So I believe that Rivian has a lot of upside potential. And last thing I'll say about the chart, it really needs to hold around $13 now. I would not want to be really involved in it if it went down below that too much. And this 15 to 1650 now will be the calendar range high to clear. And then I see no reason why this can't go up continually as we go through this year and the next couple.
Got it. Well, before I get to Chris's pick, what you just said there is a very good point. I mean, I always let people know when it's in the forward to the report, this is a point in time. We ask for contributors' picks for the next 12 months, but of course, markets change, economies change, stock prospects change. So I always remind people, if you're reading this report, follow the work of these people, go to their websites, use the links that are in the report to go to their pages and subscribe to their products because they may like something now. Things could change in 6 months, 4 months, 8 months, who knows? But that's an important thing if you're watching this to keep in mind. Chris, I do want to ask you now, I mean, your play, BYD, obviously is a global play in this sector. What do you like there?
Yeah, so BYD is the ADR ticker symbol. It might be the one EV maker that kind of makes Elon Musk sweat these days, but only in one country, China, which is where they do roughly 90% of their business now. But they're expanding globally. They have factories in the works. They have a plant in Uzbekistan that's just underway. One in Thailand that's just started deliveries. And they're expanding or opening new plants in Cambodia, Hungary, Indonesia, Pakistan, Turkey, Mexico and Vietnam are possible targets as well. No U.S. footprint in the works as of now, although they do make electric buses in California. I'm not sure that's moving the needle a whole lot. But so it's one a lot of U.S. investors aren't familiar with, and I think that's that plus sort of the China baggage these days has limited the stocks. The stock hasn't gone along with the growth of the company at least the last couple of years. When they pivoted, they've been a huge car automaker in China for years, but they pivoted in 2022 to all EVs and hybrids. And when they did that, revenues tripled that year. And they've continued to climb, they haven't tripled every year, but, to the point where they sell more EVs and hybrids as they did last quarter than Tesla. So it's a little bit of a value pay. I mentioned earlier that, it's in Warren Buffett's portfolio, so it's a little bit of a value play. But I like the growth, and it's clear that the stock price has not caught up with the growth. If you look at, you can make the argument that it's a bit like Tesla, 8 to 10 years ago. It's trading at 15 times forward earnings. And by the way, that's less than a quarter of its 5-year average forward PE ratio, which is around 90. And you compare that to Tesla's, it's just a fraction of it. Not to denigrate Tesla in any way. And I agree. I like Mish, your pick of Rivian with clearly under Trump, especially the America First agenda should benefit American car companies. And I too am seeing way more Rivians on the road than I did even a couple of years ago. It used to be sort of novelty a couple of years ago to see one. Now I see them just basically anywhere. But BYD, if it'll have to combat a lot of U.S.-China tariff baggage, but I still if we're looking out multi years, I really like its potential, and that includes this upcoming year.
Got it. Perfect. Tom, I want to get back to your last pick. My household may or may not have spent some time on the website this holiday season. It's Etsy. Obviously, a lot of people know what that company does. What's your case there?
Yeah, this is another one of my favorites, down 80%. We like to buy things down quite a bit. But what's very interesting is the price is down 80%. But like I say, price is what you pay, value is what you get. Their growth rate decelerated post-COVID. They had a huge surge in COVID. They are the fourth most trafficked e-commerce site in the US behind obviously Amazon, Walmart, and eBay. 92 million users. But what's beautiful about their business is it's a niche product, handmade, customized, named product. So it's not a race to the bottom in Me Too products where you're just competing on price, which they couldn't compete against Amazon. And Amazon had tried to compete with them years ago and realized they couldn't and got out of the business. So, and then you got a winner like Josh Silverman, who was successful at eBay with shopping.com, founded Evite, sold that to Barry Diller over at IAC Interactive. And then when he was at Skype, he grew 300 million users. So, you have a situation where they had the huge growth. They've been able to keep that level of free cash flow, keep the peak level of COVID revenues. And it's now trading at about a 9 times free cash flow. So they got so much cash gushing in, healthy balance sheet, a turnaround in plan. They've got this gift mode. They've better curated the website. They're growing internationally. They're focused on men. They've got all these initiatives in place that are getting traction. But at the same time, they're buying in all the float. So they just announced $1 billion buyback. They bought in about 9% of the shares in 2024. So effectively, just from the free cash flow, they could buy in the whole entire company in about 9 years. And that alone, if they didn't grow, but it does look like growth is reaccelerating. And this is the perfect combination of characteristics that we look for in turnaround situations. So we think this is going to be a great one over the next couple of years.
Perfect. Well, I mean, these are some great ideas. Obviously, I appreciate you taking time out to talk about them here. They're in the report. I do want to briefly mention, if you're watching this, Mish will be joining us at our Dallas event coming up in April. So you can check that out on the moneyshow.com website. Mish, you're also marketgauge.com is the best place to go for more information, right?
Thank you.
Tom, as I mentioned, if you're familiar with his hedgefundtips.com website's fantastic. Lots of great information there, great ideas to look at. And Chris, what would be the best place for somebody to get more information on your picks? I know I get to see your articles and other materials when I digest it for our website.
Yeah, CabotWealth.com is our website. I run Cabot Value Investor and Cabot Stock of the Week. And then I have a weekly podcast called Cabot Street Check that is available.
Perfect. Well, again, all these contributors were in the 25 Top Picks report. You can go to the link in the description of this video, get your free copy, take a look at what they had to say in more detail. Mish, Tom, Chris, thank you so much for joining me, and let's hope for a very profitable 2025.
Thank you.
Mike.
Thank you.